Okay, gang, so what we're going to do after this, I'm just going to recap a little bit now before we go any further with Barclays, Investec, Coutts, Johnson Reed and MAF. I want to just quickly go through my rules of raising finance. Hopefully then, when we do this little session, you're armed with some of the questions or some of the answers that I know certainly the people towards this side will be asking. And that's all about how we raise finance. How do we do it? Let's get into it. I think first things first, what does your business look like when it's finished? If you was going to see a venture capitalist, if you was going to raise some serious amount of cash where security's not there, say you're I don't know, raising 100 million to go and open 300 restaurants or 400 hotels. No one's got personal security for that sort of money in the round. So these venture capitalists are asking what your business looks like when it's finished. Now, I use a very simple chart for this, and my team are now going to go and give these charts out to you because I think this is a really clever way of working out what your business should look like in 12 months' time and also when the business is finished. And this is crucially the one. What does our business look like when it's finished? I think is the first thing you should be asking to raise finance for your business. So we want to do it in two stages. It's really simple. I use this all the time when I'm thinking about things. Again, it's like us playing that fantasy football game that we're thinking about. Now, usually people go, we want to build a £2 million business, or we want to build a £20 million business. No. I mean, the classic one. Let's talk about the profit first. What's the profit going to be? Then we work out what the revenue is going to be. We're back into this reverse engineering stuff. Then the big one, what's the team look like? And this one I really want to come to in a minute. What's the culture of the business? I don't think so many financiers care about that one as much, but it's still important for you. And then crucially, what do you do? So we're going to write 12 months here and when the business is finished here. So let's just make up a company. We're going to call it ABC Limited, that old classic. And we're going to say in 12 months, we're going to have a 250K profit business. To do that, we're going to go for a 10% net profit margin. So we need to get 2.5 million of revenue. And at that stage, you're going to want a general manager and you're probably going to want a bookkeeper. So you're going to say, this is the team that I want, a bookkeeper, general manager, maybe a salesperson, and we list out the management of the organization at that level. What's the culture of the business like? Well, for me, like I've said, one of my big culture statements, we want to be frugal on costs so we can be generous on investment. So that would be one of the culture statements. Let's write the bloody thing down. And then at this stage, what do you do for the business? So you could be the business development marketing director at that 2.5 million revenue business. You're getting in the sales for the business. You're making it happen, and you could be the MD of the business at this stage. So we're documenting what we are. Then we're thinking 10 years into the future. That's when I believe you should say the business is finished. We're working to 10-year plans. Okay, when the business is finished, we now want 2.5 million of EBITDA or profit, whatever you want to measure. And we want to say, right, let's have 25 million of revenue. But let me tell you now, what does the team look like then? A bookkeeper's not going to cut it then. You're going to need an FD or you're going to need an accountant to work for you in-house. Let's now play fantasy football with our team. What do they look like? And then we're going to say the cultural statements get really important here because it's my experience when teams go over 12 people, that's when politics gets involved and you have to work a lot harder and bringing people with you. So we're going to talk about that. And then what's your role going to be? At that stage, are you the chairman of the business? Are you just a shareholder and you've got a complete team running the bleeding thing for you? And you're going to document it. Now, in my experience, I even, once upon a time, I used to bank with RBS, and I was going to borrow a significant amount of money from them, and they said no in the end, but they actually wanted to meet my team. They wanted to meet the person that was in charge of childcare. They wanted to meet the accounts person. And when you start going up the rung of financial stuff, this here is the secret sauce. Who's the management that's going to be running the bleeding thing? It is, in my opinion, they might disagree with me in a minute, but I think it's management first, then serviceability, then security. And I think the myth is everyone thinks that most banks are security first. Can they afford it? And who are the people? I just don't think human beings work like this. Who come in and say, "Oh, can I buy £5 million? I'm a bit of a dickhead." You know, it's just not going to happen. So it's who's the person? What's the management first? If we succeed on becoming a good rounded person that seems like they know what they're doing, they're passionate about the business, they're qualified, they know the stuff, right, we understand the management's there, let's look at the affordability and then looks to see if there's any security. And that is why I use this venture capitalistic scenario, because VCs know there's no security big enough for when they're doing big stuff. You know, when Mark Zuckerberg got billions of pounds to get Facebook off the ground, you reckon he had that in buy-to-lets and houses and stuff? No, they were lending to the management of the business. Right, so how do we do that? We need to prove that we've got a business plan, and it goes in this order. So it's management, affordability, security. You want to make sure you've got a CV of your team. Have this ready, gang. Who's your power team? Who's your head of marketing? How much experience they got? If you are in Entrepreneurs University, if you are a member of Entrepreneurs University, go into the business plan section. You can download all of my business plans. In every single one of those business plans, there's a whole section of the CVs of the management team that are running those particular businesses. You give all this stuff, because if the bank manager wants to lend you the money and he likes you, he's going to have to send this up and write a report and send it to some credit team that don't even know you from Adam. You want to actually give them the tools to get them to say yes. I feel very uncomfortable really doing this bit here, because I realise most of my bank managers are in the room. It's making me a bit nervous. I hope I'm saying all the right stuff. There they are. Look, all of them over there. Oh, it's like a funeral, isn't it? Right, okay, that's the end of me by the end of the day. Right, I like doing this little scenario here. This is a little story that I used to teach when I've done seminars. It's completely made up. And this is a story of two men that I've made up that want to open a pizza restaurant. Which one would you want to lend to? In fact, they don't want to open just a pizza restaurant. They want to open a chain of pizza restaurants, 100 pizza restaurants each. Now, the bloke like that, he's worth loads of dough. He's got loads of property. He's worth 30 million quid. He's got loads of money. But he's never, ever done anything to do with pizzas other than he's fat and he likes eating pizzas. That's as much as he knows about pizzas. Now, the other one that's sort of like this, could be the other way around, but I'm going, the one that's like this. Now, he was the managing director for Pizza Express. He knows about his EBITDA, he knows about his spend per head, he's got a brilliant management team, but he's got no security. He's got no security. He's got £1 million to put towards a thing, but he absolutely can try, tested and proven, tell you how to run a chain of pizza restaurants, because he's done it in a management capacity before. He knows how to build a team, and he knows the business inside and out. They need 100 million, so they need 10 million quid to do it. This bloke over here, he's got all the security, but he don't know how to run the business. The one on the other side, he's got no security, but knows how to run the business inside and out. It's a rhetorical question, gang. Which one do you want to get behind and back? Because do you really want to take someone's property and house away from them? I don't think banks really want to do that. I don't think any finance company really wants to do that. They want to back great management. So your job, hopefully in this next session, is to really take away that management is the secret to it. I'm going to do some more stuff after them, but I think we're going to welcome them on stage now. Can we have some music while we get them up on stage? We've got Russell from Barclays, Greg from Investec, God, I do know him. I was about to call him his nickname. Peter from Coutts. I don't know who we've got from Johnson Reed. I've forgotten. And I don't know who we've got from Math Finance. Oh, you're coming up. Right, go. Let's give them some music. Round of applause. They're coming up on stage. We're going to do this live funding panel debate. Here we go. I've lost the pieces of paper. Wherever, oh, thank you, gang. Yes. Take a seat. Take a seat. Right. Oh, you're coming up. Here we go. Here we go. Thanks very much, Jenks. Right, so what I've done, Gav, I'm just, while these guys get themselves comfortable, say hello to each other, what we've done is, did everyone get the email where we asked you to fill in a contact form if you wanted to raise money to grow your business? Hands up if you got those emails. Most of you did, and we've chosen some to ask. Now, if at any point you've got an intervention, you want to ask a question, I'm going to be down here. We're going to ask them to see if they would theoretically get behind a particular deal that I propose. But I think we'll just, there's 3 microphones. They're all turned on. I believe they're all turned on, yeah. We're just going to get you to introduce yourself and what you do. Starting over here, Dave, with you.
Dave Chapman, I'm Managing Director of MAF Finance Group. So we've been going about 13 years now, and we've got 56 staff, and they're all ex-bankers, specialists in what they do, really. So our USP is we have specialist divisions, asset finance, property, healthcare, agriculture, renewables, supplier finance, vehicle management. And each division is run by someone who's been working in that industry for 20, 25 to 30 years. And they've been with us, 5 to 10 years. So we're whole of market, so we do work with all these guys and many more, probably a dedicated 50 funders, core 25 to 30 where we're regularly giving a lot of business to, but we've always got a home for quirky stuff too. So that's about it.
Thank you very much, Dave. Jamie?
Hi, Jamie Collier, Johnson Reed Finance. We are a 20-year established alternative funder. We lend 25 million a year to passionate owners, investors. We have a particular appetite for what we would call quirky equipment. Probably the kind of assets that your traditional high street banks don't like. We have a team of 15, and we see probably about 50 different business plans, operating models every month. That gives us a really wide range or scope for the type of businesses that we would like to support.
Jamie, just sorry, before we go on, please, what is a weird piece of equipment? Can you give us an example?
Absolutely. So I actually quite like funding air conditioning or security systems, but our probably preferred asset is something that is a revenue generating asset. So your slushy machine at the back, James, is perfect because I know how much cash and profit that business, that asset will make for you.
Fine, got it. Okay. PQ. Peter Quinn, sorry.
I'm from Cooks & Co. We've been around a lot longer, probably than most people, most actually, for years. We deal with private banking and commercial and corporate banking. I've known James
Yeah, he's amazing, Peter. But yeah, there we go. We come on to that. Greg, Greg, every time I heard you, I always think of a South African accent. Greg's got personality. And I found out you've got a famous brother, haven't you? Not really to talk about that.
Moet ek Afrikaans praat?
What did you say?
Somebody got that.
Yeah.
There you go. I mean, I'm happy to speak about the 2019 Rugby World Cup final and the 2007 and 95 and probably 23, but they'll bore you. So I'm from Investec. Our genesis is actually South Africa, so we've been around for about 40-odd years in banking. We're a specialist bank. We've got a couple of pillars, but fundamentally where I sit and what's of value to you here is I'm an investment banker at heart. But ultimately, we lend, and when we lend, we try and create wealth with our lending. So that's why I'm trying to help James. He's apparently not wealthy enough for his own standards.
Thanks, Greg. It's a funny way to not get invited to that next year. Russell, you've been one of my bank managers for years as well.
Yeah, I think everyone knows who Barclays are. We've been around over 300 years. I'm a relationship director working in Essex. Our little team probably lends about 100 million a year. Traditional sort of high street bank doing traditional lending. I've worked for them for about 35 years.
Brilliant. Right, before we get into it, I just want to ask some questions that I think a lot of people are thinking at the moment, and I'd like everyone's honest answer on this. Has anyone opened their Apple News app recently and seen some of the economic warnings that we're getting? I think my first question to you is, I saw 365, I take this as on residential mortgage deals, not really the bag for you, but so I think 365 mortgages removed from the market yesterday, which is one of the biggest ever. So my direct question, I think a lot of people are thinking this, are you getting from the gods that be in these organisations that you work for or are connected with, that you are going to stop lending money to businesses here in the UK? I think we'll go with you first, Dave, if you're a broker. You're going to have to use the microphone, though, because that's...
Well, we don't do regulated mortgage per se, because it's the regulated homeowner, I guess, where the question's aimed at. But I suppose my view on it, really, I mean, everyone's thinking rates maybe move to sort of 5-6%, and obviously, rightly so, they're probably evaluating the position out of the funders at the moment, pulling the fixed rates, because they just need to consider where they're going to come back in the market and pitch them at, and maybe they're going to leave them a little while till things settle. But
have you actually had... you've worked with all the market. Have you actually said to them, we're not really wanting to lend yet? Or have you got everything carry on as normal?
No, we're carrying on as normal. As I say, we're lending in the commercial space and property space.
But what about a tightening then? Have you noticed a tightening, or is everything as usual?
No, it is a bit tighter. Yeah, it is a bit tighter. I suppose in our world, that's where it helps, because certain banks will tighten, certain banks will tighten policy criteria, loan to values, but because we've got a wide spectrum of funders, it allows us to circumnavigate around some of those. But yeah, there's definitely a tightening and concern with rates at the moment, definitely.
Okay. What do you think is going to happen in the next 12 months? 12 months?
Well, we can have a bet on it, can't we? I think rates are going to move. I think they'll probably move 4 or 5, whether they'll hit 6%, but who knows. I'd sort of hold tight on variable rates, really, before fixing.
Can you see Barclays down the end there, but can you see them lending to businesses then? If you're thinking base rate 5-6%, or do you think... So they've got to put a margin on top of that.
Yeah.
So that you can see people borrowing from a bank for a commercial mortgage at 8%.
Depends if they need the money. It depends for what purpose, really. I guess some of your thinking.
But what I'm saying is, you don't think that seems like woo-woo? Because 24 months ago, if you'd have said someone like the High Street doing that, that would be out of the question.
It's certainly going to reduce lending, isn't it? And borrowers are going to think about whether they need to purchase the asset. But I suppose if you purchase an asset and it's working for you and it's generated income, generating profit in your business.
Yeah.
I mean, if you look at development funding, for example, we have no problem with funders leveraging all the time, well before the interest rate rise and scares at 7, 8, 9%, because they're working that money hard, and with 18 months, that interest cost isn't major to their bottom line profit, and they're selling the houses, generating upside. So I think it's the application of the monies is key. If you don't need to buy the asset, maybe you're going to wait and rent a bit more, maybe you're going to wait for rates to settle again. But if you've got a need for the money and you want to pay the higher rate because there's an upside for you, I think people will still look at it. Yeah.
Okay. Are you still... So one more to you, Joe, because David, I just think because where you're a broker, are you still finding that you're getting loads of inquiries for people to do business and borrow money, and that hasn't weaned off?
I think we're still busy, and I think the answer for us is because of the diversification of what we do.
Yeah.
So, for example, just off the top of my head, if someone's purchasing a property, they might think twice about using the cash as deposit, but then we'll look at the business. We might restructure some of the borrowing against the yellow plant, for example. So we might release cash from the yellow plant, extend the term, keeps the cash flow neutral potentially, but puts that deposit from the yellow plant into the property and buy the property that way. And then potentially the property can either be geared up or it can be free of debt then build out.
Got it. Okay, Jamie, over to you. Jinx, I'm just going to just over here if that's okay.
Yeah, I see two things that will have an immediate impact in our ability to lend money to our customers. One is the changes in property values. There's an estimate that these will maybe drop in value over the next 12 months. 30% of the businesses we support are in their infancy, in the early stages, and we therefore require directors' personal guarantees. Those guarantees only have value if those individuals are homeowners with equity. And if we find that more new start business owners have squeezed that amount of equity because the property values have dropped, those guarantees will be worth less and we will end up lending less to them. There's nothing we can do about that. The second thing that will have a big impact is the businesses that are working with very fine margins, where they're going to struggle in a weaker economy. There's a concept or a philosophy I've heard about, which is the flywheel effect, where you've got many spokes of the wheel, which is gathering momentum. In a strong economy, that flywheel is moving fast, and let's be honest, you can probably run a bad business and still make money. But in a weaker economy, it's only the stronger businesses that will survive, the ones that have maybe built their own little flywheel. And James gives lots of advice about finding other revenue streams or bringing the costs in-house. Trying to buy little sub-companies that supply your business. And they all have a knock-on effect and keep that momentum going with the flywheel. When I see businesses that really perform, I see that flywheel in effect. And there was a customer I met recently who's got a karting track in the northwest of England. They've go into any karting facility and you'll find that you just see customers coming in and renting karts. These guys have got a race team. They've built a championship. They're even talking to a TV production company, the media arm of the business, which will then potentially build your, if you've seen Drive to Survive on Netflix, they're building a karting equivalent of that, which again will just hopefully bring this influx of youth or people into that market, and they will be their future customers. So lots of innovation, lots of ideas, but the property and that'll work.
I think we sit slightly different as a bank because we don't really tend to deal with too many startups. We are the more mature entrepreneur. We have always built in base rate rises no matter when it is, when we are in the economy. So we always go, what if? And then we take EBITDA down by 10, 15%, for instance. So we're building in a lot of fat into that. It goes back to what you were saying as well. We're looking at management first. It's not just security and then serviceability. So if that management team can stay there and they've got the right idea, they can trade through it and they can demonstrate that they've traded through it. You're going into now a cycle back to 2007, in effect. The biggest issue that was people not having capital to trade afterwards when there was a success or a growing economy. So that's where I think the biggest thing is going to be. Have we stopped lending? No. The mortgage stuff, you have to look at that as how they get their capital. So a lot of these people who are only going 2, 3, 4 weeks in advance, they're now looking at that cost and going, what we put our rates out at isn't going to be achievable. We're not going to make money off it. So that's where you're seeing some of that scale back on that basis.
Thanks, BQ. Greg? Sorry, tech guys, you couldn't just put the clock on here, otherwise we'll just be here till midnight. Cheers. Over to you, Greg.
I'm not particularly sure how I actually answer that question. I think people underestimate the geopolitical shifts that are going on. Let me contextualize that slightly. So what do? We look for proven entrepreneurs who have done something, who already have wealth and are trying to do something that is sort of non-clearing bank specific. And we can get into all the details if you want to. So our clients would always be people who have already done something. And we are therefore backing them. So we're backing what we would classify as backable, or we would colloquially say we're backing good jockeys. The problem is that even the good jockeys haven't seen this stuff before. So, and I can guarantee you, nobody here can say that they've seen this stuff before. And from a banking perspective, we would always do our sensitized case. In other words, take whatever you think you're going to perform at and say, okay, well, we're going to now reduce that because we need to look at it from a lending perspective. And we would always say, okay, well, what happens if revenue dropped off? Okay, how does that affect the business? Well, what happens if costs go up? Well, how does that affect the business? Very rarely in the last 10 to 15 years have we said, well, what happens if interest rates go up to 6 or 7 or 8%? At the same time, costs going up, and at the same time, revenue falling off. So I think people underestimate the geopolitical stuff that's hitting the world. To answer your question directly, have we stopped lending? No. In fact, we're quite bullish because our clients are seeing opportunities. And so when our clients see opportunities, and we've backed them before and we know them, we tend to follow our money. So we're very much looking at our existing client portfolio. Are there opportunities? Do you want to do more? Let's do more. We find that we get more yield out of that at the same time. Remember, at the end of the day, we want to back the right people. But I think your question would be, if you asked me the question, would we be very open to new clients coming to the bank? Yes, but I think it just becomes more selective based on what's going on geopolitically, not based on the client. I think the client is the client, but geopolitically, I think things are shifting.
Is that in terms of, Greg, sorry, so you guys obviously have a credit team, the three at the end, not that I'm picking on you three, but you guys, you're bank managers, you look after the clients, and then you go upstairs. I always say upstairs, but I know it's not, I always say that, but I don't mean upstairs. I don't know why, I just always imagined, with the bank, there's upstairs, that's where you go. You go upstairs to your credit team. Are they saying we don't really want to do anything, or is it...
No, I mean, I had lunch with the chief executive of the bank last week. The answer is no, we're open for business. Now, will that be more selective? I think the answer is yes. But it's not selective. We don't want to do more business. We don't want a client. We're just trying to understand fundamentally what drives a balance sheet and what drives cash flow. Well, it starts in your P&L. So we have to just understand a bit better what is the impact on the income statement, because that is going to feed balance sheets and ability to debt service, i.e. be able to pay debt back. So we're just taking probably a little bit more time than we used to do a deal, rather than saying we're not doing deals.
Yep, okay. Russ, what about you? Oh, PQ, did you want to say something? He's getting into it now, look at him.
It comes back to what you were saying, it's going to be backing the right people and seeing people that have gone through this before. Startup businesses are going to be the ones that are going to be the most difficult to actually fund, because there's no history, you've got no proof and concept of it. That's the biggest thing. You see the best business plan you've ever seen in your life. I've seen a few of yours. I would say the best. They're certainly worthy, aren't they, Aaron? So, but no, that's going to be the hardest thing. So we are looking still to lend, but it's that history and being able to prove it and not being over bullish in this market as well.
Yeah, I'd agree with what the other guy said. No is the answer to the question. I guess we're probably quite cautious anyway. So as Peter said, we already build all of that in anyway. So we'll stress our rate. We'll add 3% to the rate and make sure it's affordable even a year ago. So we're already doing that and looking at, if rates went up, what would we do? Nothing's changed in our policy in the last 3-6 months. It's exactly the same. It did at the end of COVID. We made some significant changes. They've now come back again. And we're not changing them, so we're still as open for business now as we ever have been. I think probably would be mentioned and interesting what you put up earlier, James, about the three things, the management team being important, and I think that's absolutely right. I think, especially in this type of environment, because you're looking at historical figures, aren't you, with regards to looking at affordability and what has a business done. When things are changing and things are difficult, it's actually the strength of that management team that can often be the most important thing, because it's about what you're going to do in the next 5 years when you've actually got the loan, not what you did 2 years ago. So yeah, absolutely key.
Just one other quick thing. So if we cast our minds back to 2007, 2008, I think, it's obvious banks didn't have cash. But I read regularly that banks have got more cash than they've ever had. I think this is, I'm not asking you to say something that isn't in the public domain, but I think it's worth just saying to them that the banks are, especially Russell, you're well funded, aren't you?
Correct. But we don't need any more deposits. We're probably we're overfunded, so that's not an issue. It's not.
Just say that bit again, because I think that's really. So you've got more cash in the balance sheet.
The issue is risk, James. It's not availability of funding. We're not in a position where we're worried about having the money to lend. It's around who we lend it to and on what basis we lend it.
I think lessons were learned.
Yeah.
2007.
But the same for Coutts, which is part of the NatWest group, isn't it? But you guys have got super strong balance sheets, better than you've ever had. Is that right? Or
yeah, but part of that is we have to as well.
Yeah,
because there was a change in regulation change. That means that banks should never get in the position they were in 2007.
And Greg, is that the same for Investec? You've got really strong...
Yeah, it's the same, and we were regulated by the PRA, the prudential regulators, so you have to hold your cash buffers. Banks are funded quite differently, though. So our bank will be funded slightly different to a Barclays. It's just basically the magnitude of Barclays versus an Investec. But we would always classify ourselves as being long liquid. In other words, what do we sell? We sell cash. You sell, I don't know, cups and saucers. We sell cash.
Yeah.
You got to have stock. We got to have stock.
Yeah.
We're just funded probably in slightly different ratios in terms of what the buckets look like.
Yeah.
But I think all the banks today have to be long liquid.
Yeah.
And otherwise the regulator's going to come with a very big stick.
I think it's just something that I understand it because I'm boring and I like this sort of stuff, but when just approximately, and I don't want you to go into the absolute minutiae of the detail, if you lend a business £1, I'll ask you, Russ, what does Barclays keep on its balance sheet for every £1 it lends?
Don't know.
Can't you just make something up that sounds good?
I could, but that's not going to help anyone, is it?
No, but you understand the thing. Like if you're lending to an owner-managed commercial property of a 20-year-old trading business that makes 300,000 profit a year over, say, investment commercial lending to buy a warehouse to rent someone else, you'll have different capital ratios you've got to keep, haven't you? And that is why it's more expensive, or so you're told, to get a buy-to-let mortgage than a residential owner mortgage. Just nodding. They obviously, they're starting to get clever.
You'll have buckets though of different types of lending. So you'll have the more risky bucket. You'll have your standard mortgage, and then you'd have another, for instance. So you're going to price it accordingly into that, and then our cost comes accordingly. So it's a risk versus reward. So if we're lending to someone at 50% loan to value on a prime London real estate for it's a 20-year-old business that shows £1 million a year, that's kind of a no-brainer. That's going to cost us less compared to if we're lending at 100%, for instance, or unsecured.
So if you lent someone at £1 million, just what does the bank have to keep in its balance sheet that it didn't do in 2008?
I don't know the ratios exactly. I think our Tier 1 capital ratio's something like 15%. I have no clue what that actually means, but it's good.
Yeah.
So it's one of the strongest out there. So that's the way of looking at it.
Yeah, I could try and help you a little bit with that. So we structure like equity. So again, we're in the investment banking side. So I think all your banks are probably holding between 10 and 20%, or 10 to 20% of your core Tier 1. So in other words, for every pound we lend, we probably hold between 10 and 20 pence in the pound, I think, is what banks have to hold. But every bank is going to be different. I think the point that I'd like to make is that it's not just that, and I think the guys were touching on it earlier, it's also got to do with some sophisticated models around loss given defaults, estimated losses, and so forth, and that drives banking capital holds. So it's very sophisticated on the back end, and banks run with, I don't know how many people sit in Barclays and Coutts and these guys, but for us we've got an army of people just looking at regulatory capital because of the regulation that's come towards us. So it doesn't matter what size of bank you are, we're all sitting with the same amount of regulation upon us, and so we all have to sit with regulatory capital. It's regulated. You just have to hold it.
It's probably a good thing as well coming past 2010, because banks were lending money incorrectly. RBS Group at that time is a prime example. We lent too much money to certain people at too much high levels. So now the risk factor has come back, and that's where the cost of, or our Tier 1 ratios of capital, how much we've got to hold to make sure that we don't default again and we're not government owned again on that basis.
Okay, just one more quick question for me. Do you as bank managers sometimes get frustrated that you see, well, this is where used to really come in, I'm priming used to up really in this question. You see really good businesses, but you just can't lend them the money, maybe because they haven't got the security, but the management is great, the affordability's there, but they haven't got the security. And then we've seen the rise of Funding Circle, and the rise of the Johnson Reeds and MAF Finance. I mean, would MAF have really worked 30 years ago when you knew your local Lloyds bank manager or your Barclays bank manager, you pop in the branch, you see them? I feel like, I know, I mean, let's just see this. How many people have got what they think is a really good traditional old-fashioned bank manager where they've got their mobile phone and they can pop and have a cup of tea with them? See, and that says 1, 2, 3, 4. maybe 4 people out of
Are you
200.
going to put your hand up?
Yeah,
thank you.
Yes, sir. I don't-
Aaron?
Yeah,
Thank you, Nick.
But I think that is a big shift. If you'd have asked this room that 20 years ago, even 10 years ago, I think that's a big shift. And so they don't know where to go, and that's the whole point of doing something like this. I also get it's expensive for banks to do it, and to be fair, Russ and Peaky, there's no point in you really lending someone 50 grand, is it? It's not really. You're on exorbitantly big salaries, aren't you? You've got chauffeurs and stuff like this. So you cost.
Thanks for excluding me from that one. Yeah.
The last time I was in a car with you, did you drive?
Anyway, yeah. So basically, they got me there, didn't they? I forgot my question now. My question was, do you get frustrated sometimes that you can't support what are good businesses? Russ, I see you nodding.
Yeah, of course we do. I mean, I think that those 3 pillars you talked about earlier, we need every single one of those, and you'll often only get 1 or 2 of those. You might meet a great entrepreneur with a great idea, but he's got no security and no historical figures to prove that he can pay anything back. It's difficult.
But what if they have got 5 years trading, made consistent profits, but they haven't got any security?
I mean, fundamentally, as a high street bank, of course, Barclays will be an asset bank's lender, so our appetite tends to be security-backed lending.
Yeah.
I'll work with someone like Dave from MAF to place that with other people that sit on the panel that maybe have a different appetite, that will lend it unsecured or will lend it under different parameters, to hopefully still help that customer, even if we maybe don't have the appetite to do so ourselves.
Yeah, I think banks will take a view on some of that, but you've got to remember, if you're doing an unsecured transaction, your repayment's going to be a lot quicker. So
Yeah.
you may look at 25 years if you're doing a commercial mortgage, but an unsecured, you may only look for 5 years, or acquisition funding maybe 3 years, for instance.
Yeah.
So it's then making sure that the business behind it can actually afford that as well.
Yeah.
So that's always going to be the sticking point. That gone are the days where banks will do 20-year committed money because it's just too costly.
I mean, I'll add to what I just said. We do structured unsecured finance, but we only start to look at that for businesses producing an EBITDA on a last 3 years average basis of £500,000.
Yeah.
So it's for bigger businesses, maximum term 4 or 5 years.
Yeah.
So it's an aggressive amortisation profile. The business has got to be sound to be able to do that.
That's what Dave, and this is, who refers you the most clients? I think this is a rhetorical question. Is it Barclays, HSBC, NatWest? Are they giving you?
I wouldn't name particularly one. To be fair, I mean, we do
As a
work
collective,
closely with a lot of high streets banks, and I guess you might even say yourself, Russ, you might have a long-standing client, but if that bank has got a set parameter or set policy, they will try and stretch it and help the client as best they can. But the client just might need some extra leverage, and they might need cash in from somewhere else. So, like I said earlier, by releasing cash on a certain asset, it could be a truck, it could be a piece of yellow plant, putting that into a property deal, you might need a 250k unsecured facility to put that in alongside, and it's really piecing the whole jigsaw together to see how we can get to what the client wants in terms of the totality of their funding requirement, really. And there's little ways of doing things. The PGs are there. You can insure PGs, which helps the entrepreneur relax at night. It gives the comfort to the funder because it's almost cash backed if they ever called upon it. That can make a difference to get a deal away sometimes.
Hands up who is happy to personally guarantee stuff for their business. That's good. Do you guys feel that you get loads of people? I don't want to personally guarantee.
So could you ask that question again?
I can. Are you shocked by that? Who's happy to personally guarantee their business? Well, you don't have an option. No, I don't know. Yeah, that's it. He said you got, for those at the back that won't hear, he said you got 2 alternatives. You personally guarantee you get the money. If you don't, you don't.
James, I think that's a bit of a Marmite question. In my experience, you'll either have customers that have got no problem at all and sometimes even offer it, expect it,
Yeah.
because they know they're not going to get the money otherwise, and happy to do it. They're back in their business. And I think that gives the bank more than just the bit of paper guarantee. It shows that that business owner is willing to back it. So that says a lot. On the other side of the coin, you'll get people that will fundamentally not offer that under any circumstances, because they just don't want to.
But Russ, would you ever lend to a business that wasn't prepared to give a PG?
Yeah.
Am I learning stuff I don't know? Then?
We always prefer it because we always want more security than
We'll always
than
ask
that,
for it.
Yeah. So
It would always make me nervous because anyone that's not putting skin in the game,
Yeah.
yeah, it's a tricky one. But I just want to answer your earlier question, James, about about the difficulties that you'll find when you're declining customers. And I used to work for Lloyds 15 years ago. I joined Mark at Johnson Reed because of those difficulties. I just saw we were turning away a lot of customers with legitimate business plans. We've tried to rectify that by finding a larger lending panel and approving over 90% of applications that come to our door. So it's access to finance that's probably your biggest question. Some people need a quick no. You don't want to wait 4, 5, 6 weeks to
absolutely.
be, you just want the harsh, brutal reality sometimes of you are not strong enough for that amount of money. This is what your application needs to look like. And we can give guidance, we can give help. I mean, we work closely with business support groups, with British Business Bank, with accountants who will then go in and say, work on you called it your photo frame, I call it the one-page business plan. I want to see it because if you've not got it in front of you, what's going to happen when things do go wrong? Are you focused on what's important? But what we've also done is try to lend on our own book. So when we do see depressed markets, 2007, 2008, we found lenders not wanting to lend. As a broker, that made my job bloody difficult. So we've tried to lend on our own book now. It's not a large lending book, it's modest, but it does mean that when someone is speaking to me about a new application, that they are speaking to someone that's potentially going to make the decision, yes, we will approve you finance. And that decision within 24, 48 hours might mean the difference between you securing that equipment at the right price before it goes up 20% in the next week. So those things can be valuable, I find.
Yeah, it's really... Actually,
Jay,
yeah,
sorry,
go on,
could I
Greg.
just add, you might need to exclude us from the we there. We don't always require personal guarantees with our structures. The reason why is because sometimes our view would be a personal guarantee is there for alignment. So now everyone's feet's in the flame. In other words, if we're lending to a business, well, we'd like to get that money back. Just like if somebody was lending to me, I'd like to get the money back. So it's an alignment point.
Yeah, I agree.
But sometimes you could look at a personal guarantee and see a phenomenal business and say, well, actually, why don't I back the business? Because I've got a good jockey, but the jockey doesn't have the personal guarantee. So what's really the point of the guarantee? Well, maybe it's a little bit of alignment, but ultimately, if I mitigate that slightly by getting into the equity, well, then I can start taking a different view. So I think for everybody, just if I'm speaking sort of slight Greek, you just hold me back. But when you talk about risk and reward as an investment banker, personal guarantees are sometimes important, but they're not always important, so long as you can align me on the upside. So if you can align me on the upside through the equity curve, then I start to put less relevance on what would be a personal guarantee, because ultimately the personal guarantee is for alignment. So that's where you start to move the pendulum away from personal guarantees, more towards, can I get a deal done? Well, pay me more, or you've got to provide the security. So the more security you provide, the less income the bank's going to want to get. The less security you provide, the more income the bank wants to get. So it's in that pendulum.
Yeah.
Now, as you referenced earlier, you had the venture capitalist. Well, they want 75% of your business. Private equity wants probably 50% plus. Then they take strategic and operational control because they sit on your board. Then you get on the other side, you get, I guess, sorry for speaking sort of more on the clearing bank side, it's asset-backed stuff, so it's full security-backed. Where we play is slightly on the inside of that curve, which is maybe not so much security, but backing really good jockeys and then sometimes getting into the equity. So there is a whole pendulum of capital and finance out there, which you should be looking at, not just thinking it's one-trick pony stuff, either personal guarantee or not a personal guarantee, as the case may be, because I don't think that's... I think if you want to grow your business and increase your wealth, if you take that binary position and you're not thinking more laterally, then I think you get stunted on trying to get capital because you're just constantly hitting a closed door.
Okay, fine.
Hope that helps.
Oh, no, I find that interesting, Greg. Just one quick point on that. So how often are you taking equity in people's businesses in return for cash, Greg? Like, how many deals do Investec do on that? Regular?
Well, we're a big bank, so I can only speak about our business. We do enough.
Are you allowed to? I'm
mean, it's-
thinking of one that we went for dinner with. Are you allowed to talk about that or not? I don't want to.
No, I guess the one thing we're very cautious of as investment bankers is talking about clients and portfolios and risk and
fine.
reward.
Okay, we won't talk about
because ultimately we're trying to create some serious wealth for people.
Does the bank really want to take equity in a
Well, we
business?
don't take direct equity. This is also another nuance. I mean, maybe I'm boring everybody here, but from a regulatory perspective, the moment a bank takes equity in the business, I think from March 23, it's 400% risk-weighted assets. So to your question around how much capital the bank needs to hold, let's pretend it's 10 pence in the pound. From March 23, regulatory-wise, we've got to hold 400%, i.e. 40 pence in the pound. It doesn't make sense to take equity in a business.
Yeah.
So you've got to align somehow through a structure, which is what we do, which is, I guess, a slightly different to a more sort of standard asset-backed lend.
Fine. Interesting.
Hope that helps.
Well, so got hands up if you're enjoying this, if you're thinking this is good stuff, brilliant. I knew that you would. Right, so in my hands, I've got we sent out an email to everyone that's here today, and they had to, I'm going to tell you the questions, because these guys haven't seen this. Maybe some of them might have seen it over my shoulder, but I promise you nothing too owner. They haven't got into the minutiae of the details. So we're just going broad here, and no one's giving any credit back lending stuff. But what I wanted to get from this session is, maybe you can hear Barclays go, yeah, that's the sort of thing we want to do, or MAF say, yeah, that's the sort of thing I think we can back, and hopefully, no, that sounds like a load of rubbish. It's certainly not something that any of us can get behind. That I think, Jamie, you said a really, really strong point there. If it's a no, people want it fast. And I want to actually, before we go to the floor, how long are you finding, we'll start with Russ and we work down, if you get a proposal sent to you, how quick do you get a yes or a no back to the client?
I'll probably give them no myself if I know it's not going anywhere. As you said earlier, my job's to put that case together and represent that to the bank in the best way that I can do, and then it goes upstairs.
So you will say no straight away, but if you can say, yeah, this is, I think, something we can do, how long does someone need to plan?
I can get a credit decision probably in 48 hours.
I don't believe that. In my career, I don't believe that.
Might take another 3 months to get it drawn. But I can get the decision in a couple of days.
Yeah, in all my career, and I love you, Russ, and I think you're amazing. I just don't believe that's true. Greg, what about you?
Do you believe 72 hours?
No, I don't. But
No.
I've never had that.
No, that was a joke. My kids always tell me, Dad, if you tell a joke, please tell somebody you've told a joke. So that was a joke. They actually did tell me that one day. Again, slightly different. We, as investment bankers, probably have to take a little bit more time to look at something. I mean, yours is a case in point where we pushed back quite hard on one or two things. Not because you were sending us anything erroneous. We just need to see it in a particular way.
Yeah.
What I would counsel your guests is you also need to find experienced guys on the other side of the phone.
Absolutely.
And if you don't, you need to ask yourself some serious questions as to whether this thing can really go. So, us guys here, we're pretty experienced. It says, he sees something very quickly, he can say, this ain't going to work.
Yeah.
That's a quick no. I think the issue when you get inexperienced people on the other side of the phone is they don't understand how to consider the no, so they don't consider what the art of the possible is for a structure. To answer your question directly, we always take about 4 to 6 weeks. I mean, you're experiencing this.
Yeah.
4 to 6 weeks for us ourselves to get into the right headspace.
Yeah.
We then probably take about 3 weeks to get our investment papers together. But remember, we don't write credit papers per se because we're not necessarily asset-backed. So we do 3 weeks of actual investment underwriting. And then, I mean, from once we've got bank approval, I mean, I can do my legal docs in, I don't know, 5 working days if I have to. But sometimes it takes longer. And ultimately, every single time it's client-driven, taking time because we've got lawyers on the other side that are probably not as efficient as we need them to be. So, start to finish, 12 weeks.
Okay.
Let me give you an example, James. You didn't believe me, and I didn't like that.
Well, no, I don't mean that like that. Right? I just, in my experience, I just don't think I just think things take a lot longer, and that's what I'm trying to get to.
I had a client come to me early on in the year that wanted to put a bid in on a property, 2.2 million, on the Thursday. Their sealed bid needed to be in by 12 o'clock on the Tuesday. I had my signed off sanction from the bank Monday morning to allow them to do that. So we can move that quickly. It's an existing customer, great deal, not that difficult to get it sanctioned, admittedly. Debt service was good. Everything else kind of ticked our boxes, but you've still got to go through the process.
Russ, is that a unicorn? Is that an exception rather than the rule?
I took myself off the road completely to do that. So yeah, it took me 2 full days to write that paper, do it, or get it over the line, because it was really important to the client. If we didn't get it done in that timescale, they would have lost the property or not been able to bid. So yeah, maybe it's not the norm, but it is possible for the right deal. I still think we'll do it in a week.
And I think the point that you said, that you knew the client, it wasn't like this is a brand new, never known to bank and all that palaver. And I think that, my job is to sort of be a mediator. These guys, by the way, I know them all, and they've been part of my life for a long time. I think a lot of them, but I also just want to let people know that the amount of time I believe it takes to get funding deals over the line, especially, this is not your fault, especially when the people that begin with S and of elicitor after the letter get involved, it then grounds to another halt. But yeah, PQ, go on.
I think it was a little bit loaded from you on that, because it's dependent on, is it once we've got all the information and we can then take it to credit, or is it from first meeting to completion? Because I think what you're saying, I could get a decision in 48 hours if I've got every single piece of information. We've had a meeting, financials work, and we can then go from there. Post it completing, that's a completely different ballgame. You'll know at the moment how long legal searches are taking, for instance. They're normally 4 to 6 weeks, of anything up to 14 weeks. So that's out of our control. What I would say is, if you're going to a bank and you're making a proposition, have the information ready, have what they think, or have a think about what they're going to ask. They're going to want your annual accounts, management accounts, projections, your business plan. Have all of that ready before you actually go. Send it to them before the meeting. You can cover that off in the meeting. They can then take it away. It's then going to take a day or so for them to actually do the meeting, read everything, come back to you with some faults. If you're then happy, you can then progress it. You then take it through a credit application if I think it's a goer. Yeah. And then that does take a bit of time to write a report up.
Oh, you're really good. Peaky, you won't send anything upstairs. As we go back with upstairs.
Downstairs in our
You
office,
won't send anything up, would you, that that the bank are going to say no to?
It's a waste of time.
Yeah. And you'll look like Greg's here.
So just to cover that off, you get experienced guys who know the deals that we should be doing.
Yeah.
But bear in mind, your credit committee is a regulated committee. So it's set up by the regulator. Therefore, it's arm's length. And so sometimes, and just certainly for your guest here, please understand, we can do everything we can do, and it could be the right deal, but there might be a regulatory issue which none of us will be aware of. And that is standard. Unfortunately, prudential regulated authority dictates those things, and sometimes we just don't know. And so sometimes it could be that it ends up being a no, but we just wouldn't have known. So it's not your fault or our fault. It's just sometimes there's a regulatory issue that's sitting somewhere. And you'll never know. We'll never know. Yes. Yeah, so you yeah. Yeah, so that's a really good point. The slight nuance there is that we can be made aware of significant amount of regulatory changes. But what I'm specifically referring to, for example, is if there is in the bank, per se, there might be a sector-related issue, which we won't necessarily know about. And once we hit credit, we realize what it is. But unfortunately, that just does happen. And as much as they try and filter information to us, and we try and get information from them, there is sometimes those gaps. To allay the fear slightly, I don't know how long I've been doing this. maybe once a year, if that, we'd probably come up against this. So sort of violently agreeing, we know what we're doing, but there are times, and they do unfortunately happen, and unfortunately, as Richard Branson worked out, you do one bad thing on an airline, they tell 100 people. You do one good thing, and they tell 4. So it sometimes happens. So I just want to make people aware of it.
I see it when I put stuff up that we don't go to the high street for our borrowing now. We borrow many millions for our business. And the reason we don't is because they're too sludgy and too slow, and they don't join up. The conversations aren't there because in a board, in the committee, that week they've changed their minds. They're not into hotels because of COVID, or they're not into commercial property because of the slide on rents. And that changes month or week on week. That changes. And I've been rejected on certain stuff just because whoever set that up for me, putting it up, this is usually high street stuff going up, the nuance made all the difference that it all got chucked out. And they weren't, the bank manager wasn't aware that they have now this different view because they're not joined up together.
Which sector are you in? What business are you in?
Jamie's, I'll intro you. You'll love Jamie's. I'll speak for you, Jamie, if you don't mind, just to keep it. Jamie's got a lot of commercial property. He's on the panel with me tomorrow, and he owns a really lovely hotel wedding venue as well. He's a very super successful entrepreneur, multiple exits, but unfortunately, probably like me, you get worn down a bit by it, don't you? And but you use Unity Trust Bank, don't you, mainly, Jamie?
Well, we use UTB, but coming back, just while I've got the mic in my hand, what you were saying earlier about people sell cups and saucers and you sell money, with what's happening with the climate coming in now, I'm having to sell my cups and saucers a bit cheaper to keep the cups and saucers going out of the warehouse. Are you banks going to be doing that for us?
Bloody hell,
Yeah, I can pick that up. First of all, and this is a very direct answer to your question. That is not a. That is
know
not
what the answer is.
Yeah, the answer is we cannot give those answers because those are all sort of regulated sitting in C-suites. Where I think it is slightly different with banks is we have a risk attachment point to where we are. So if the risk is up, then we get rewarded appropriately for the risk. That's just banking. It gets one-on-one.
And as small businesses, we have a huge risk that sits on our shoulders. So we're only selling stuff like you're selling stuff, and you're trying to mitigate the risk. What the panel said today, I'm beating the panel up, as a room full of entrepreneurs that want to get on, you're offering us nothing coming into this climate with what you're saying. Well, you're not, because you're saying that all of the restrictions are going to get harder. We're still lending money, but it's going to be tighter and tighter for loan to value, for personal guarantees. You want the belts and you want the braces. If you listen to my tone, I've borrowed a lot of money over a lot of years, and I've been beaten up by a lot of banks.
So, did you take any COVID lending? You don't have to answer that yes or no. How quick did that work?
I didn't take the COVID lending.
Okay. Anyone else in the room? How quick did it work? How quick did you get the money you needed during COVID to keep your business going?
That was amazing. I think that was like, I just thought, why can't it be like this all the time?
It was a reaction, I would say.
Yeah.
Are the banks going to start becoming cheaper, I think is what you're saying? Yeah. Well, no, because we've got a cost that we still have to serve. Our costs, like your costs, go up.
Yeah.
So if as a personal level, my electricity bill's still gone up £200 a month. My mortgage has still gone up £150 a month. So it's still going to cost the bank more money. So we still need to be a business, and we still need to be profitable because we're not a charity at the end of the day.
Peaky, can I just ask, what about, I reckon all of you are going to get clients come to you soon saying, right, can I fix my rates? I know the cost of borrowing. What's Barclays' view on that?
First time I've had those conversations probably for about 7 years. But yeah, they're happening quite a lot now. People are starting to fix rates, have started to fix rates.
But are you doing that?
Oh, yeah. I mean, the cost of, say, 5-year money over a variable rate is probably running at about 2.5% premium. So what I mean by that is if we're charging a client, say, 3 over base, they'd be paying 5.25.
Fixed?
No, variable. But on a fixed rate, you're probably paying 2.5 over and above that.
So 7.5s and 8s to fix
5-year money, yeah.
That's going to change daily at the moment.
Changes every week for us.
Yeah, that's something that, again, we can't control. It's the cost of the bank going into the market and potentially having to borrow that money as well. That's, as I was saying with the mortgage lending, that's why they've had to scale back, because they haven't got that pot at that level that they can lend that at. Otherwise, they're actually losing money on it.
Yeah, got it. All right, let's get into some of these questions, and then I'm going to come down here. So basically what we did is we asked their name, what their email address was, what your business name is, what the sector you're in, how many employees they have, what's your annual revenue, what's your annual profit, how many years you've been trading, and do you need money to grow your funding to grow your business, how much do you need, what do you need it for, and how strong is your business in your opinion? So just a little snapshot of the business. I know it's not the detail you'd like, but I would like you to, when we said no, or yes, we'll take it upstairs. If we could have a no, or yes, we take it upstairs, that'd be great. So I'm going to ask these people because I'm going to be sharing some stuff about your business. I'm going to call out your name. If you are not happy with us going through what you've sent us, and although we have told you this is what we're going to do, but I don't mind, I've got enough here and I think enough to go through. So if you want us to move on, just say, look, James, actually, I'm not up for this. So I'm going to ask Pillow Partners. Is Pillow Partners here? Can you stand up, sir? Let's get a microphone over to him. First of all, can we have your permission to talk about your business in front of 250 people and 5 banks?
Go for it.
Say that again?
Go for it.
Yeah. Go for it. Good. Where are you from? Glasgow. So this is Scott Weir. His business is Pillow Partners. Just very briefly, 20 seconds, what the business does.
Pillow is the UK's leading social impact short-term rental company.
Okay, so you put it here as a travel tech property company. You've got 35 staff in the business.
Yep.
Annual revenues of 1.6 million, annual profits of £200,000, been going 6 years. Do you need funding to grow your business? And Scott said, I'd like £2 million. We said, what do you need it for? And he said, I like smart cars. He didn't say that. He said, I want it for expansion. And then I put this, I'm just going to read this to keep things spinning up. How strong is your business in your opinion? So this is Scott's view of his business. Protect making since launch? What does that mean, Scott?
Profit making.
All right, so you just spelt that wrong. That made me look like a dickhead. Thank you. So profit-making since launch, strong at the moment, but it would be weakened with more lockdowns or stupid government nonsense. This is a proper entrepreneur. Oh, flag the government off. So lockdowns. I think we can accept that those days are gone, God willing. We've branched out from management into travel tech so we can generate income from outside the UK. So just with 20 seconds, what do you want this £2 million for?
During lockdown, when we couldn't legally make money in the UK, we set up a US subsidiary registered in the state of Florida, which was open. So rather than being stuck here doing property management, we've developed a travel tech platform with a charity and local community focus. So we want to enter multiple markets, go into 3 countries in Europe and go into 3 states in the US, so that we're not just a UK company.
Okay, just quickly for Mike, because I'm struggling to understand this. I don't know if you guys are. What do the 35 staff do? Are they software developers?
We have some developers. They're predominantly property managers, customer service, finance, and marketing.
And when you say property managers, just what? I sort of understand, but it means so many different things. Just give us...
Nice and simple. We look after people's Airbnb properties to simplify it. So give us the keys. The team will do absolutely everything. We charge 20% commission on any bookings that we generate and manage.
So out of your 1.6 million revenue, you're paying all your staff, you're paying all your costs, and at the end of it, you've got 200,000 of profits. And have those profits been consistent for a number of years, or just...
They have been growing every year. We had a little bit of a hit during lockdown. The staycation boom has been good. I think we are growing at 7% a month, so that's the current turnover, but growing probably profits and income at 7% a month growth every month.
Can I just ask quickly, sorry, your profits, are they before your drawings?
No, after. My personal drawings after.
Dividends?
I don't take a lot of money out of the business, so I think we only took 36,000 dividends this year, or last year.
So your 200,000 would be post-dividends. So it'd be your EBITDA, post-drawings, post-dividends.
Yes.
Basically, I'll just... you take a salary of 30, or you're taking the dividends as 36,000, so you're adding that on to 200,000, or is the 36 including the 200,000? Is that what you're saying, PQ?
That was the money.
Scott, we're putting you up on the... So he basically makes around 200,000. I think we're going to go before we get into that. Right. And then just wondering, do you keep cash balances in the bank, or do you exhaust the cash in reinvestment?
No, we take money, put it out like Profit First, Mike Malkovich. We put money in, so we've probably got about 200,000 in the bank as a buffer for a rainy day. We just reinvest that into various things like the tech platform, but there is that minimum. I like to keep 150,000 in the bank and then reinvest the rest.
So, in my opinion, before we ask this up, that to me sounds 100% bankable. But my personal opinion, I don't think you get 2 million quid on 200,000 of profits. But let's see what they say. Oh, I wish we had like the blankety blank theme tune. Blankety blank, Russ.
No. Very highly leveraged. We'd probably only look at going to 3 times leverage. So you're looking at probably 600,000 on a 200 grand EBITDA. And obviously the big question around security is always going to be a big one for us from a high street bank, because we wouldn't lend 600 grand unsecured.
Scott, is there security, personal guarantees, property?
There could be probably 400,000. The 2 million was just a general figure. We've been over to Silicon Valley speaking to VCs, and that's based on an American valuation, totally different in the UK, and that was just our dream number to grow the business to £25 million revenue.
So have you
is
got
that money going to be used overseas though? So is it going to be used to grow the US side of the business?
It would probably, some of it would definitely would need to be, yes.
Yeah, it would be a no, because there's no recourse to that business to us for where it's being used.
It'd be a no from us as well. UK only, I'm afraid.
Thanks for picking me first, James. That's brilliant. Thank you for ruining my reputation.
Yeah. What's the debtor book look like, or who's your customer base? We're just trying to understand a bit more of the business, really.
Second one, customer base with 2 main customers. Firstly, holiday homeowners or service apartment owners. The second one are the guests that come to stay with us.
Okay. I mean, for us, we'd probably be, to be honest, we're raising cash on the property to release, which might be up to 70-75%. Could be a combination of capital interest and interest only. Are you actually purchasing software, IT and software in the business, presumably?
Well, we subscribe to third-party software. We've built our own travel tech platform that has some IP and a value there. So we don't own any property.
No, but is there sort of IT equipment as well as software, like?
Probably not a lot of capital things. It's all third-party software that's subscription-based rather than us owning stuff.
Okay. So without quizzing you anymore and seeing if there's any other background, I'm sort of in that space. Might be 3 times leverage on the EBITDA, raise money on your property. Might be a little bit more on top with a PG, which could be insured or not insured. I think the 2 million, though, I guess the point is, did you really have a justification for 2 million, or you just picked 2 million out there because you asked the question?
It was based on, again, speaking to VCs, venture capitalists, and they said, well, that's really the number we would go for as a minimum.
Yeah, that's their game, isn't it? They want to...
That's fine, yeah.
Just, I'm sure you are, but you talking to your accountant about R&D tax credits because you're making all your own software?
We have been claiming that for the last 3 years.
I absolutely, because I've had my fingers burnt on this, make sure you get a second opinion on that. Especially John that guy, remember him with the no hair. He knows some really good people, and he does R&D, but he knows some really good people, and it's worth having that second conversation. It might go nowhere, but they might get you more. I'm just putting that out there because
Presumably, sorry, go on.
So PQ, one of PQ's clients that I met at this swanky dinner thing, he got like one. I'm not his. It might not have been his client. It might be someone else that I met just at that bank and having a chat with them. I know they got £1.4 million back on R&D just into their bank account. Bloody hell, I couldn't believe it. And he was a software-y, techie company, and you definitely got to talk to people that are very good at understanding that niche. Greg, do you want to? Is this something that you might?
Did you say you had a valuation done on the business?
Yes, but it was a US valuation of $10 million.
$10?
$10 million. Which is different from the UK, but it's hard to get accountants to value IP around platforms, so we're in that process at the moment of getting a full UK accountant to get a proper valuation.
So my answer to you on the 2 million would be no. But I think, coming back to that sort of pendulum piece, I think the question is, you're here, you want to get here, how do you get there? That's the role we'd fulfill. So if you got a $10 valuation, it might be that we can stretch, but it might be that you need capital injected along the way to get you a valuation of 100 million. That's what we do.
Cool. Okay, this one is Abid Jaffrey here. I hope I've said that. Have I said the name right? Let's get a microphone. Before we go any further, you're happy for us to talk about your business in front of 250 people? Yep, good. Just like to make sure everyone's okay with this. Okay, so this is. Let me just say your name, just so I know I say it properly.
It's Abid Jaffrey.
Abid, sorry, Abid. So this is Abid. Company is called AJ Sports. It's a sports good retailer. So you're in retail, yeah?
Yep.
Banks love retail at the moment, so I'm looking forward to this one. Why is everyone laughing? I don't get it. What's everyone laughing? I don't understand. You've got 17 staff, doing about 1.2 million of revenue, £86,000 worth of profit, been going 7.5 years, needs funding. He wants £150,000 to grow his business. What do you need it for? Growth and working capital. How strong is your business, in your opinion? We have 3 retail outlets in London, 1 freehold. Look, Russ, tick, he's getting into this. PQ, we've got an asset here. We've got 1 with a mortgage, 2 on leases. As a separate sports retailer, focusing on cricket, hockey and rugby. We have a very loyal customer base. Our current estimated EBITDA is around 10%, with a consistently grown year on year, an average of 30%, focusing growing forward on growing high growth online team, blah, blah, blah. Current online sales at 10% of revenues with the aim to increase this 50%. This is interesting. So you get 90% of your sales from physical brick and mortar stores,
Yes.
and 10% online. And so your GPs must be quite slim, are they? I mean, I'm just interested in this for myself.
We work on around 30 to 35% gross profit margins.
So out of that, you got your staff, your overheads.
Right. Well, if you look at the profit, it's around 8-9% net.
Wow.
EBITDA itself is a very new concept to me.
Yeah.
Through your Entrepreneurs University.
Yeah.
I've been studying. But yeah.
But see, I think EBITDA is really important in a business like ours. We're buying carousels and dinosaur parks, and we're depreciating a lot of cash. But I suppose you must have loads of cash in stock at any one time.
Yeah, we are very cash intense. So
how much? I'm just asking. I'm just going to speed it up so they'll ask. How much cash do you have in stock at any one time on average?
Oh, a lot.
Do you do a stock take each month?
Not each month. It's we are doing it quarterly.
So my personal opinion on it, we've been talking about it in our businesses. I think if you are holding, you must have at least 300 grand's worth of stock.
Probably more.
Yeah. So you're not worried about theft? You've got 3 sites in London. That must.
We've got good. In terms of theft, you can only do sort of security and stuff, CCTV and all that sort of stuff, but it's not a lot more you can do, to be honest. Obviously,
there is. Stock takes, I think, are the fastest way of solving theft. I'm just putting it out there from my opinion. Right, but we're here to talk about funding. We can catch on that later. So, any questions you'd like to ask him directly?
Yeah, can I ask a question? Sorry, what was your name?
Abid.
Abid. Abid, just to scrutinise what you want the money for, how would you break that down?
So basically, we are investing into a warehouse. So it will be a leasehold warehouse. We've outgrown our storage capacity in all 3 stores, and we've been growing quite quickly. So that warehouse location we'll treat essentially as a 4th location, where all our online sales and all our sort of teamwear clothing business will be done through that warehouse location. So that's essentially it. And then about, I would say, half of that is for that, and then the rest of it is working capital.
And is it a warehouse in another location, just so that you're logistically sort of spreading your net across the UK, or are you just looking to increase stock levels?
It's just outside the M25. Egham is where the warehouse is. Just signing a lease on that shortly, but we are looking at different finance options to fund it. Our cash flow is there if needed to fund it, but I don't really want to dip into it because we are relatively seasonal at the moment. So our busy period is summer, and then our cash flow sort of dips around this time, but we want to take advantage of the opportunity.
Yeah. Can I just say, please, one of you, because this sounds to me like textbook, a guy that really understands his cash flow, he knows his numbers, obviously. Please help him, one of you.
Just to sort of answer your question there, I mean, you mentioned you got seasonal business.
Yeah.
One of the points you mentioned, James, about rich people or wealthy people still borrow money, and why would they borrow money when they've got it? And it's to talk about the PropCo. You want to try and invest as much money in there as quickly as possible. The ability to finance some of that expansion through lease finance is absolutely a possibility. On our panel of lenders, we would see your warehouse fit out as a legitimate asset which we would fund over a 5-year term. We'd lend up to 20% of your current balance sheet with no PGs, anything above that probably with, as a very crude measure. But with you being a seasonal business as well, it's possibly worth considering a merchant terminal-based lending facility, which does have inherently higher costs, but also doesn't require fixed repayments. So you can essentially be paying back on a fixed percentage of your revenue, therefore causing less strain on the business. We see it quite often in things like children's soft play businesses, where it's busy during the winter months, but absolutely dead in the summer months. So that could be another avenue worth considering, and get freeing that cash up.
I was just going to say that is horrifically expensive, isn't it? And I just can't sit here and say that I think that's a smart thing to do.
We do get a lot of letters through the post offering us that.
I mean, I'll do it. I'll do it. I honestly, I think they're worse than drug dealers, them things. I mean, I'm just putting it out there. The APR is ridiculous, and I just don't really want anyone that comes to mind. So I get it. It's a mean to call some people, but oh my God, it's like you borrow £1,000 and you pay back £5,000 in 20 minutes. It's not. I'm just exaggerating it here massively. But I think that is so expensive. So if there are cheaper, I always want people to get the cheapest money possible. But thank you, Jamie. You really, gave some great answers there. Anyone else on?
It appears bankable, just on the face of it. I would say it's got legs for you to go to someone with, but go, as I said before, with the information.
So we bank with Barclays.
2 days.
I went to them, got a no.
Why do they do that?
Basically, we did not have enough equity in the commercial space. We had around 60K's worth. We obviously need more than that. So they did ask for more security, but we don't really have much more. So now I'm looking at the unsecured lending side of things. So, yeah.
How much would they lend you?
Around the 50, 60K. But, Barclays, or... Yeah, so the bank manager just said that you don't have enough equity. He said it's only 50 to 60K, so there's no point looking at it because it would take time as well.
The thing as well, Russ, is that I think you're working to higher turnover businesses, aren't you? Where how many clients have you got?
50. 50.
Peaky, you've got, how many have you got? Similar sort of?
65, 70.
So I think a million, 1.2 million. He's probably got a lot more clients and just wants to get it off his desk. I mean, I'm not speaking for. I don't know the person, but do you think that?
I think just because you've come with a debt requirement at a certain level, the bank will, as I've said from the start, will always look at security as one of those three pillars. So if you've got some equity, we'll take the value of your property. We'll take 70% probably of that value in your sector, maybe 65 in retail actually. Take off any existing debt that you've already got, and whatever's left will be the available security to the bank, which is probably what you're talking about. So if that's not enough to cover a loan for what you want, but I don't see that. If the bank will say, look, we'll lend you 60,000, there's potentially other ways. If you're putting a load of racket in your new unit, you could potentially asset finance that. What he talked about, lighting, all that type of stuff. You can finance that type of stuff.
But the thing is that Russ, he's probably got a bank manager that is not trying to fight the system to get it through.
But he should be.
Yeah, I know. This is where I think Jamie gets the and I get the sometimes. Really, if I was his bank manager, I'd be like, why are we not doing this? The bloke's got... And really, I mean, the thing is, I would be careful in saying you're retail to them. Because I know, that's why I made that joke. They just... What these, I mean,
what do I say then?
They don't like retail, do you? No one likes
You've got to be honest with your bank, James.
No, but you should say... You are a specialist niche provider of sports equipment. Because you're not competing with JD, are you, here?
No, we're not.
No, I'm not lying there. You're a specialist niche provider of sport. Look, Jamie's getting it. Look, his fingers are going. Storage and distribution.
You say that, but then it's what we have to do is put it onto our system. And so we have to look at the codes that you've got for your limited company, for instance. That's going to come up retail.
Yeah,
you can't then lie.
Yeah.
Well, I would be changing it to specialist supplier of niche sports equipment.
What I'd say, James, just because retail...
But can I just say, that is what he is. I mean, he's not...
No, he's a retailer.
I'm trying to help it. But I get the point there.
But just because that's a challenging sector, that doesn't mean we won't lend into that sector. The story I just told earlier on about the deal I sanctioned in 48 hours, £2 million, they're a retailer. So we're still lending to retailers, but our policy may be, we might only lend to 65% loan to value, not 70. Maybe some of the criteria that we've got will be tailored towards the risks that we consider that particular sector to have. And the bank will always have preferences over different sectors. But that's not to say that if you're retail, don't go to your bank because they're not going to lend you any money.
So can he come and have a chat with you, Russ?
If he wants to.
Yeah, see if you can help it. I don't. You feel like you're there. You feel like you can help him as well as Jamie.
Yeah,
there's going to be options.
I mean, just look at it quite simply. You could do a 5-year unsecured loan. You could do a combination of 5-year unsecured loan with something on asset finance. So we could fund the LED lighting. We could fund the racking in a warehouse. Any kind of asset like that to fit out a space is soft asset funding. So yeah, you might be looking at 8 to 10% on that. But how much is the warehouse cost as a fit out, sorry?
So we're actually we're looking into getting a mezzanine floor in as well.
Okay.
So it's total cost to get it all set up would be around the 30k mark in terms of the fit out.
Right. Yeah. So the fit out could be funded on asset finance, and even if some of that is a mezzanine floor, it's viewed as a soft asset anyway. That level of funding against the financials you said shouldn't be an issue. And the rest could be done on a 5-year unsecured loan, potentially.
Yeah. Well, there we go. There's some options here.
Yeah.
Can I just say, if I was a bank manager, which I am not, but if I was, I wouldn't want to lend to anyone in retail. I'm just, being honest. So, but where there's niches, and I always believe there's riches in niches, so I'd be homing down on your niche so much more. And I would be knocking on a few doors, and I think these guys will be able to come and talk to you. And being online, you just got to do it. The other thing, I just thought about, the mezzanine finance, the mezzanine, I've just confused everyone because there's another term of finance. I don't mean that. The mezzanine floor, the people putting that floor in, have you asked them to finance it for you?
I did not know that was...
That's a little trick that I've done. I'll have your mezzanine floor. I want to pay for it over 12 months, though.
Okay.
50-50, they say yes. Maybe 40-60.
Well, they're going to send me a quote shortly. So.
Yeah, and then I ask them and say, can I pay for it? Well, first of all, can I pay you over a period of time? I'll personally guarantee it. That's what I would do. Can I pay you over 3 years? Try your luck. And then they might go, no, we won't do it, but we've actually got a finance company that we really know if these guys can't do it. But, these are the things, the games you have to play. Right. Now we're coming on to Mark Curry. I think this will be the last one, then we'll take a bit of Q&A. Mark Curry, are you okay us talking about you publicly? No choice. Well, no, honestly, if you want to say no, I'll move on. Okay, so this is Mark Curry's business. It's called Midlands Catering Equipment. That's right, yep?
That's correct.
Yeah, so it's got 10 staff, 1.1 million revenue, £130,000 worth of profit. In 2 years, you've been trading. Yeah. I mean, that's impressive. Not many people do that.
I've kind of built and grown a business previously and sold it to a corporate, so it's my second rodeo, really.
Right, and so you've got cash in the bank, you're experienced. Yeah, I won't ask you how much. I laugh at my own jokes. It's one of my bad things, right? So, do you need funding to grow your business? Yes. Why? You've got loads of money in the bank.
It's not so much funding the business. We're fine with funding the business.
I'm getting to it. Don't ruin it. Yeah. How much funding do you need? £800,000. What do you need it for? I want to buy the commercial unit we operate out of. Come on, 2 years, experienced entrepreneur. How strong is your business in your opinion? He says very strong. 90% of our estate is education. Oh, this is sounding good. And the remaining 10% is blue chip companies. Like you're talking their language here, mate. We have a very strong half year with 900k turnover in the first 6 months. We're expecting to finish on 1.4 million with nearly 200k profit. We have a strong pipeline for the next 12 months. When you say strong pipeline, is that a genuine order book or just strong leads?
Just strong leads, yeah.
Okay, and he's honest. Okay, so let's. What about you, Russ? Like something that you would.
Sounds bankable if you've got a deposit.
Yeah, have you got a deposit?
So that's the thing. So.
Oh, here we go.
I wanted to try and hold you accountable, James, really, because we've heard so many times on the podcast if you're paying rent and you're a profitable business, the banks will throw money at your commercial unit.
Well, yeah, I've never said throw money. I have never, ever said that term.
Out of the five of you, who wants to lend me the money?
No. What I have said is if you want to buy the property that you operate out of and you're renting it at the moment and the rent is higher than the mortgage, for example, that to me, and you're established and you're profitable and Barclays have done this for me before. Russell's predecessor, Dave Oram, he said, I'll lend you the deposit over 5 years on a cash flow lend, and then we will term out the balance of the mortgage over 20 years. I know lots of people that have done those sorts of deals, and I know if you've got equity and security in the background, they will use that equity and security as a deposit so that you can protect your cash flow. I have told people that. I know that is not rubbish. I know that's happened many, many times before. People are doing it in buy-to-let all the time, and I know people are doing it in commercial property, subject to those caveats, and I'll just remind them again so I'm not making a load of stuff up. It's an owner-occupier. We're not doing this for commercial investment. It's an owner-occupier. It's a profitable business, great management team, trading in place, and you're already renting it and you have now an option to buy it. I just think that makes complete and utter business smart sense. So that's
that's sort of bread and butter business for a high street bank, really, for us. I think you're right in what you say to an extent. We will fund the deposit, but that's where there's other security available. So we'll typically lend up to 80% of a property value for an owner-occupied mortgage. If you've got another property that isn't geared up to that level that you're willing to put into the pot to bridge the extra, if it's £1 million property you're buying, and you need to borrow another 200 for your deposit, and you've got another property that's got equity of that, then yes, you can certainly do that. I think we'd struggle to lend the deposit unsecured as well as lending the 80% commercial mortgage.
Barclays did it for me and Dave Oram did.
How many years ago was that, James?
He's retired. But no,
15 years ago.
What he did, I just think you need to be honest sometimes, with your funds. Say, look, I want to protect the cash in my business. Why are you putting the business under stress and duress? I want to keep that for working capital. Just lend me the deposit over 5 years. And I think, if you knock on, enough people's doors, you will get those deals over the line. I've got them over the line. But subject to
How long ago did you do a deal like that?
15 years because Dave's been retired a long time.
No, you have lent me money for property, but there's security in the background.
Correct.
Yeah.
Mark, we've lent you money unsecured.
Yeah.
On a cash flow lend.
Oh, so you agree with me? There
no,
we go.
but that wasn't to buy a property.
No, but
there was assets in the background. But again, it comes back to your three pillars, doesn't it?
But there are lenders out there that will do that, and so typically we might be happy to lend the 80%, and then if you want to raise some funds elsewhere, that's where I might go somewhere like MAF, who would probably have to find a funder to raise that 200, maybe on a.
Yeah, but Barclays wouldn't be happy
we wouldn't be interested in doing that. We'd be more than happy to do the commercial mortgage, but we would then look to.
If you would say to your credit team they've raised the deposit elsewhere by borrowing another.
Long as the affordability stacks up and everything else was right.
Oh, there we go. So you could go and borrow 200,000 from MAF for the deposit, 800,000 from Barclays. That in effect is your 100% funding. Yeah.
Can I ask,
Jamie, if you want to speak, we need to get your mic, mate, because the people behind can't hear you.
Good question. What does the debtor book like, Mark?
Excuse me?
What's your debtor book like in the business? What amount of debtors do you have and how fast do you collect the debt in?
Being in the education sector,
put the mic up a bit.
Sorry, guys. Being in the education sector, we don't really have any bad debts, so everything's.
No, I'm just wondering what's your average debtor book? So what
are you owed?
We're owed $250,000 at any one time, really.
Okay, and your customer base is reasonably good quality, isn't it?
90% education. And
yeah. So you could potentially look at invoice discounting, couldn't you, potentially for future growth, or even to release a bit of cash out short term if that works cash flow wise.
Sorry, Dave, let's just talk about, so invoice discounting is cheaper than it was, say, 10 years ago, isn't it?
Yeah, I mean, typically between 80 and 90%, depending upon the funder.
No, I mean, so the interest rate of...
Yeah, I was going to go on to that, sorry, yeah. Yeah, so the service charge, it's about what service charge you're charging, because the interest rate over their base isn't insurmountable nowadays. It's, it's reasonably cheap, I think. You're just looking at what that monthly service charge is per turnover going through the account. But we do quite a lot of invoice discounts, and it's not the dirty name it used to be donkey's years ago in factoring days, but so it can be a good solution or part solution.
Yeah, we at present we use Close Brothers. So
they're so expensive.
Right. So you do use them for invoice discount?
We've got a $200,000 unsecured facility.
So why do you use them? Just because they're easy to deal with?
Yeah, extremely, to be honest.
And you don't mind paying more because they're easy to deal with?
Yeah, and we manage our own books as well, so they're not chasing the customers' money.
But NatWest do that, don't they? PQ now, and Barclays do all that.
There's a variety of invoice discounts there, but we can always benchmark if you want. But also, if the client's telling us they're happy, they've got a great relationship, we don't over push that, because I can give you quotes it's about price, but to compare certainly. But my question was about initially raising some cash out. So if you're already invoice discount, and then it'd be back to probably unsecured loan against the 80% commercial mortgage, I don't think the bank could have a problem, providing we could show serviceability across the business and looking at the projections and the growth. Yeah.
What about you, PQ?
I think that's going to be expensive for you because you're taking zero risk and getting all the upside, in effect, with the property going up in value. I wouldn't want to see someone. Well, I wouldn't want to fund someone being funding 100% of their property and relying on it going up in value. It will do over a period of time, but we always prefer to have someone put some equity into it. But it does make sense for you. You can demonstrate it, you can service it, because it's going to be probably more than the rent that you're paying on it. But it's where you find yourself in that business cycle.
Cool. Okay, I think, Jamie, did you want to say something? I know you're...
All I was going to say was on the 80-20, so Barclays put in the 80 and then another funder puts in the 20, how do they split the charge on the property? Will Barclays allow that split then, a second charge?
I don't think there would be a second charge.
No,
I was suggesting it was unsecured.
Unsecured loans with a PG probably, but as I said earlier, can insure a PG if that's an issue. But yeah, purely unsecured, yeah. 5-year money.
So you would get the 200,000 on 5-year money, like a cash flow loan. That's That's what I meant.
But you're right. The bank would obviously want a first legal charge on the property.
But also, I think that you would only ever do 80% for good owner-managed. This is not property investment. I think we need to make that absolutely clear. And this would only be for you buying the property that your business operates out of. You're not going to go and lend people 80% loan to value to go and buy a commercial property to rent out.
Correct.
I think everyone just needs to, just for clarification on that. Right, I'm not going to ask it because we've been, trundling on for a while. Has anyone got any last Q&A bits? Oh, here we go, Jasmine, over at the back there. I've really enjoyed this. Thank you so much, guys, for doing this. I think people have you all found this useful? Yeah, look at that. That's the most. I think that is the most interaction we've got from this audience all day, and we've got bankers up here. This is great. Right, okay, where we go? Yes, say your name first, sir.
Hi guys, it's Jamie here. Quick question regarding personal guarantees. I'm in finance myself, I should add, but they're a bit pointless, really, aren't they? Because there's no personal guarantee register. So someone like James has just quite happily said, "I'll personal guarantee that. I'll personal guarantee that." So really, they don't bring any value to the table, do they?
Well, they do if it goes wrong, don't they?
Well, but if you over leverage, so if you've given personal guarantees over leverage, it doesn't really give you any protection.
But that's when you've got to know your customer and have a relationship together. So you've got to be in it as a client, and it's a relationship at the end of the day. If you're lying to someone and you're not telling them the full financial background, then you're going to get caught out, and then that's going to mean you're going to be in further issues for it. Personal guarantees, I think, as we've touched on already, just show your commitment to the business.
Yeah.
And it showed that you're not willing to walk away. If you have a limited company, in effect, you could just dissolve it. Yes, you may then get issues with directorship and everything like that thereafter, but at least it shows from a willingness from a bank that, look, you want to borrow our money to succeed because you want the upside of it. So we're willing to give, if you take that risk against you, are you willing to put anything into the game for it? So if there is an issue, we can then say, look, we're in this together.
I think as well, if you look statistically, when businesses go wrong and banks do need to come in and get their money back, the rate that we get our money back from situations where we have got directors' guarantees are much, much higher. Even if it's things like the director still hanging around and telling us who the debtors are and how to contact them, and if an administrator's in place and the debtors and the director's on board because he's got a $100,000 guarantee on the line, then statistically a bank's in a much better position. That's why we like to take them.
A bank doesn't like calling on guarantees, debentures, or anything along that line. Yeah. So I spent 5 years in restructuring during sort of 2008 and onwards, and it's the worst case scenario having to have that conversation with someone, but it just shows a willingness for it. But taking a step back, as I said, it costs the bank a lot of money if we put it into a position where we have to call against that. Our capital goes up fivefold, so we don't actually make any money on it. It is just a scenario to recover as much as we can.
Cool, thank you. We've got a couple more down here. Sorry, is there someone? Is there a quick follow-up on that?
Because there's no register, you can have a personal guarantee.
But Jamie, mate, I don't think these guys are in charge of the register.
It makes no sense. It's so dated and old-fashioned.
But if they're not the credit committee, we can't bang them up about it, can we? I've got to stick up from a bit. They're not. Russell is not deciding what the CEO of Barclays does. He just works for them. I just got to. Yes, hello. Pardon?
That's exactly what I was about to say. We would ask for an asset and liability statement.
Exactly.
And you have to put that on
assets and liabilities. There are all sorts of liabilities that might not come on a register somewhere. I mean, I've got mortgage debt with sort of some slightly more obscure lenders that doesn't always appear on some credit searches, for instance. Now, if I went to borrow from somebody and thought I could hide that, it's fraud.
Yeah.
So what he's saying is,
Well, used to have a chat in the bar about that later, and I'll come in and join in. It sounds riveting.
And I just wouldn't recommend a fraudulent application.
Absolutely, nor would we. Right, okay, let's get some. We're going to come down here to this man over here.
Hi, me and James spoke last week. I've just sold my business and I've got about 1.5 million of cash.
Oh, a little round of applause for having that.
I'll give you my business card then.
Well, I've lost my personal bank manager at NatWest, so if you want to take over, more than can do. But we spoke about trying to go into commercial property, and I just want to understand, is it better for me to go and find one property and
Oh yeah,
apply
this
for each mortgage
this
at
is
a
a great
time,
one. Yeah, I
or
remember
get
that.
funding.
So we had a conversation. So he wants to, he's exited his business. He's got £1.5 million, and he wants to go and buy a commercial property for investment. Yeah, so you want to buy it and rent it out, and you want to do a little business part thing. Yeah.
Yeah, so I've already got commercial property at the moment,
So
but I
he's
want
already
to expand on that.
So he's experienced in it. He knows what he's doing. He's got some. What I was saying, is it possible that he could give his 1.5 million quid to? I think we'll leave you to. I mean, maybe Matt can come in. He gives his 1.5 million quid to you. What would you give him on top to go shopping with?
Doesn't really work on a loan to value basis with investment property. It's really about what rental income's coming in and how that's covered. So
say he meets all the criteria for the rental income that you
it's
want.
normally about
150%?
55%. If I had to stick my finger in the air to give a rough loan to value.
Sector specific as well.
Yeah.
So depends if you're.
So he wants a business park, don't you?
Yeah, so we need to find the property first and then come to raise the finance.
Yeah.
Yeah, basic. You would need to know what you're going to buy because it's not just security wise, it's cash flow. What can that actually fund? And
Is
then
that-
it's a reverse sort of transaction on that basis then when you look at it.
Is that speculative or is it somewhere that's already rented out?
I mean, I've only the money's not hit my bank yet, so it's.
He sold it
it's
to a
more speculative,
PLC.
so-
He's going to. See, I'm going to do the talking here for you. He's got £1.5 million. He's going to go and buy. He wants to go and buy some stuff that stacks up with all the criteria of the rental. Blah blah blah. What could he have from you if he puts his £1.5 million in, Russ?
Probably £1.5 million.
So doubling his 1.5 to, so he's got £3 million hunting fund with your 1.5 million included. What about you, Greg? Are you involved in this sort of gear? Is this something you like to do?
Struggling slightly to understand, but I'll give it a go. We do get a number of ultra and high net worth individuals that have portfolios. So they take their wealth, they stick it in a portfolio, and then they're lending against the portfolio. So they basically leverage. So you keep your 1.5 in a portfolio, generate yield, call it 6%. It's actually your cheapest form of lending from a bank. Okay, there are other forms, but fundamentally for an individual, if you've got 1.5 million quid of Shell, as an example, maybe not Shell, but Shell, go Shell, you would get a very high loan to value on that. So you keep your 1.5, you get a 6% yield on that, as an example. The bank then lends you money off that 1.5, and then you use that as your deposit. And then they lend you also on whatever your LTV is. So fundamentally, you're actually not putting a penny in, and you could probably get yourself, I don't know, depending on the LTV values, maybe a £5 million quid property. And you're getting yield on your £1.5 million portfolio. That's how we would look at structuring.
Is this, sorry, Pete, is this similar to what Hemel would do with...
Yeah, effectively, it's called an investment-backed lend. So you could speak to your NatWest person and they could put you in touch with a Coutts equivalent and they could look at it on that basis. But that would be a good way of doing it.
Or an Investec equivalent.
Or Barclays Wealth.
And is that, Greg, based on a super A1 quality covenant, though, if you're doing that structure? Or?
Well, that's where we can't really say.
No.
We're speculating, aren't we?
I'm
So
just wondering, in reality, who are you going to get on the hook as your first deal?
So
and what type
I'm
of
going to
covenant?
simplify what Greg has said there. So Hemel, who's my private banker, so Coutts has got the regulated, and you're in the non-regulated part, aren't you? So there's commercial banking, private banking, similar to NatWest. And Hemel said, if you sell your business and sell it for £1 million, give me the £1 million, and I'll invest it in FTSE 100 companies, for example. Yeah. So super safe stuff. But then they will say to you, but you can then say, have an overdraft of £1 million, or maybe less than the million.
you wouldn't do 100%. There would probably be 75, 80 a push.
But you then also get the returns of the $1 million invested as well. So NatWest, Coutts, Barclays invested, they'll go and invest that in the market for you, but then lend 70% of that back to you, which you pay interest on, with the money you've given them. This is great, isn't it? So with the money that you've given them, you pay interest on, but you can borrow it. But then if the markets go up, and I think the 300-year average is 8% a year, isn't it, if you look at it? So, and you can have a steer on what sort of companies the bank invests the money in?
What sort of funds, yeah.
Yeah, so if you hated Facebook, for example, you could say to them, don't invest in Meta. Yeah, that right, yeah. So that could be a really cool thing to do. And I'm annoyed that I didn't even think about that.
Your thought process needs to work towards leverage. Yeah. If you're liquid, you need to think about leverage, not about you putting your 1.5 in. It's how much you can get extra by having the 1.5. So leverage is key for you.
And then, sorry, with Investec, I know Coutts do so.
I don't think Coutts do the same.
Oh, no, all right.
Nor Barclays.
We do.
If you do you pre-arrange the lending? So he's put his £1.5 million in. You're going to lend 70% back of that to do commercial property. Is that sort of pre-agreed at the onset?
Sure, it's a structured transaction. Sorry, open and honest. I'm not sure how these guys structure, but so our desk in the private capital, we would structure that with our wealth colleagues.
Yeah.
I assume it's similar for these guys, but that would be a one structure that comes towards you. Then it would just be a very simple. It's very simple lending, by the way.
And just out of interest, are they making good returns in your experience, all three of you, on the return of the shares being invested on behalf of the bank? Good at that?
Well, I don't think you really want to put today's stock market as a proxy, but I think you probably want to look back at who your wealth manager is, and they would be able to show you the trends. I think probably 3 months ago, not ideal. Today, if you were in the right stocks, you're going to be up, but I think it's going to depend entirely on your portfolio.
Oh, okay, well, do you understand that? It's quite a lot.
Yeah, thank you.
I can introduce you to someone, or you just speak to these guys. Right, I think we'll do... Okay, we get this one over here, Paul, and we'll do another couple then.
Hi there, my name's Jack, and I run a property development business. I actually wanted to shed more light on commercial funding, because the way it sounded like you could gear up 1.5 million for this chap here on commercial buildings. And you did mention it's all about the covenant and the yield, but I think there was a bit of a missed message thrown out into the audience about what you could leverage. We've got a run of 5 industrial units that we're trying to release some equity off that's completely ungeared, unencumbered, and there's not a lot of lenders currently that will leverage that 50%. In our development company, and I'm sure this chap, given that he's exited a business, is probably looking to find something that he can add value to. That might be a vacant building, or a building that's quite dirty and needs polishing or re-tenanting or re-adding value to. There's not a lot of high street lenders that will back that, and you may actually have to look at a challenger bank and a more aggressive bank to buy a building that isn't tenanted, to fill it, and then refinance that challenger lender out.
Just before the panel answer that, I think that's why Jamie's frustrations, he's obviously busy in ice cream right now, so we'll let him there before we get... Jamie, we're talking about you with your ice cream. Yeah, this guy here's got 5 commercial properties, completely unencumbered. He's gone to the high street banks and they've not really been interested in leveraging that.
So there's 5 good covenants. There's 3 on 10-year leases, 2 on 2-year leases.
So it's all good stuff.
And high street lenders weren't interested, really.
But just accept that you need to go to someone like UTB.
So we have gone with the challenge lender, but
who have you gone with? Just out of interest?
It was more to say we do a transaction of a commercial property every 7 weeks, so I'm quite familiar with what we can borrow.
Just quickly, sorry. You said you've got 3 on 10-year leases.
Yes.
Is there break clauses?
5-year breaks.
Upward only?
Yes.
I don't see how someone's not financing that.
I'm saying currently like this
who
week.
Who are the covenants?
They're all mum and pop. There's actually a children's nursery, not yours, but someone else's, an architectural practice, a gym, an engineering business, and a ground care company.
I don't understand why that's not been...
Yeah, I suppose my point was more...
Who did you go to? Come on, who did you go to?
NatWest, who we bank with. I suppose my point was more, if this gentleman's looking to buy something that he can add value to, high street lenders might struggle to lend on that particular asset if it's not fully tenanted or the leases aren't strong enough, which I felt, listening here as someone that arranges these mortgages, and I normally go to challenger banks because I'm buying something I can add value to, whether it's getting a better covenant in place or extending the building or changing the use class or whatever it may be. Challenger banks are a lot more aggressive and can lend a lot more proficiently than a high street lender who would be better to come back to once you finish the work.
No, you're right with
Yeah,
the
I agree with
challenger
that.
banks. They are, because they've got a mandate. They've got more money probably that they need to try and lend, more than what we need to lend. So they have to make sure they're getting that return, because their capital is going to be probably more expensive. They're going to charge you a lot more as well, I would assume.
Yeah, we're
probably
paying
6-7%.
Yeah, high single digits, all the way maybe up to double digits in some cases.
The high street banks would always look for cash flow.
Yeah.
Because that's where you're going to repay. So even if you're going in at 40%, you don't get a tenant for 2 years. You're 40%. If you're going to have to roll up interest because you can't afford to service it, you're suddenly up to 55%. You can't sell the property, so we have to sell it.
This is kind of my point. So we've sat here and pretty much by large we've said he can take 1.5 million to a commercial building and borrow 1.5 million by large. We're now saying if it's empty, what could he borrow?
I think there's a slight difference to what you're doing to that scenario.
Correct.
Because we're lending against an investment-backed product, so an investment of, I think we use Shell, for instance.
I don't think he specified it would be occupied.
No, I think I was going to add in, sorry.
But there's a difference because there is a cash flow. So that the cash flow is coming from the investment portfolio. So that the money you get from the investment portfolio will service the interest on the loan. So they work together on that basis. But that's for that scenario only.
I mean, I take your point. Obviously, we're with a load of challenger banks. And I mean, typically, to answer the point earlier, because I don't think I commented on your point, I mean, generally, we do 70% all day long on investment property on a leverage play. So that would give you 3.5 million on top of your 1.5 million. But as the guys have said, it is about looking at that particular property, looking at the lease terms, looking at the quality of the covenant on the deal. But the challengers will take your view. So you might have 2-year, 5-year, 10-year leases. And we've done plenty of deals where we're still putting out committed funds. And this isn't term, this is committed funds for 20, 25 years. And when those rates are 5 3/4, 6%, I think that's a bloody good deal because that's not a 5-year committed to, it's not a 5-year commitment in a 25-year term. It's actual committed money. And I think the High Street would probably agree that if they did want to put money out on a 20, 25-year committed basis, that would be a good rate anyway. But it will take the view on reletting, looking at the location, whereas, of course, you will get quite a bit in the high street space where they are looking at the cash flow, they're looking at the lease terms, they're looking at the reletting, they might be building in periods of time to relet, and they'll structure that cash flow through the deal. Whereas you will get, with some challenges, just a very simple view, 1.2 times cover in terms of rental, long-term money, depending on the deal.
I just want to say, sometimes if the banks say no to you, I think you have to challenge and try and find someone else in the bank that works harder because, these are big organisations. Barclays, how many people do you employ? 300,000 or something like that? NatWest Group, there's loads, hundreds of thousands of people there. Some of the people are just not good. You need to go and find the right person in the bank that's better. You must find that all the time, don't you, Matt?
Yeah, I think that's true. I mean, it's like, certain bank managers, you've got to go over them personality, character-wise, and these guys, I'm sure, work very hard and I know they do, but there's others that don't, in my eyes, because we do have situations where some bank managers will take 3-4 weeks, and that's a reality, to come back, and we've chased them 3 times, and we're probably not going to work with them too many times, actually, but we tend to just go above and go to the regional managers, and then we get much quicker decisions, really. But it's like I said earlier, I think the key is to get a good agreement in principle that we're confident we can deliver, and then move forward, really. Good. Rather than wait 2 months for a no.
1 or 2 more before we move on. We got one down here. Is there anyone else, or I might take this as the last one? Just scanning the room. Yeah, last one. Say your name, please, sir.
Hello, my name's Charlie Norton. I run a company called Norton Group. We own 4 different businesses. Predominantly, we do HGV training, license acquisition. We turn over 3.6 million a year with about 1.1 EBITDA. And I was just seeing, I wanted to go back to what James was doing with the case studies, and we're looking to acquire other businesses in the same sector, and we've been offered quite a few, but a lot of them are quite large purchases around the 2 million mark. So I wanted to see if a lender or a bank would lend us the money of around 2 million to acquire hypothetical businesses. in a nutshell?
Potentially, yes.
I love that. Potentially, yes.
I'm not here to give a commitment, James. Yeah, but when we would look to, if your EBITDA, as I said earlier, I think, if your EBITDA is more than $500,000, we've got a structured finance product purely for acquisition and MBO type scenarios where we'll look at up to 3 times leverage on for your EBITDA. So yeah, if you're looking to borrow 2 million with an EBITDA of 1.2, then that's something we would look at.
And in terms of how long the loan is for, does it go beyond 3 years? Or?
4.
Always punchy.
4 years, maybe max.
You would probably want that in 3 years, because in that time you should have been able to go in and do what you need to do in the business for it's turned in sufficient profit to actually pay for itself. So that's why we tend to look at 3 years. I wouldn't want to be doing 100% lend on that either. You'd need to be putting something into it. We would look back on your current business, can that afford it? If this other business fails, if it's your first acquisitions never go smoothly. You're not going to cut 20% cost year one. But that's fact. You're probably going to end up paying 5% more while you integrate that into your systems. So you need to build that into it, and we would look back to your existing business to say, can it afford it? And then that ticks one of the biggest boxes.
Yeah, I mean, it's worth adding, we would look at, we call it transactional gearing. So that's basically how much you're putting in to the transaction, how much we're putting in. We'd expect you probably to put in 30%. And we'd only anchor the affordability against your current trading profitability, not the company you're buying.
Yeah, so we'd be quite different. New mic. Did you say 1.1 million is your current EBITDA?
Yes.
Okay. So what you're acquiring, does that have an EBITDA?
Of about 900,000.
Okay, so that's 2 million. So we would, from our perspective, we look at them as a combined. We'd run 5-year term. We'd run curved profiles in terms of how you pay and what you pay to ensure servicing of your debt is in the right place. We're pretty happy with bullets. If anybody's not familiar with bullets, it's just waiting for a portion to be paid at the end in terms of capital. And then the question for us to you would be, well, with two fundamental questions. One, what are you actually trying to do? And I think this is a question that most entrepreneurs fall. This is like first post that they fall at. What are you actually trying to do? Because we look at it from an enterprise value perspective. So if you're saying that the business is you have to pay £900,000 for it, we work out what is the value of the business, and then we start to work back in terms of, okay, what's the equity value, because you've got to take away debt, etc. Now, if you were looking for just standard 3-year term loan, it would be very simple. Here's my business plan, here's my cash flows, and off you go. And I think, these guys would be ideally suited to that. But if you were looking for, well, can I really put some deep leverage into this? Can I really extend it? And can I take my wealth from, say, 5 million to 20 million? That's when you start to get into investment territory. And that's why we would then take different views and say, well, let's look at the 2 million. Let's look at 5 years. Let's look at curving. Make sure the debt service works. We then cheekily ask you if we can get on the equity. But that's for a different day.
There we go. I think we're going to wrap it all up there. Can we give these guys a round of applause? I have to say, you guys asked some really good questions and some tough ones at times. We're going to have a whole debate for the next hour about personal guarantees. Only joking. But thank you very much. You guys have got to go. But go on, Greg.
The mic is on. One thing I think is somewhat been missing, and I think it's probably worthwhile mentioning it, is spending a lot of time thinking about what you are trying to do. I think a lot of entrepreneurs, so we work with high net worth and ultra high net worths. So our clients are sort of 50 million. I've got one that's about 7 billion. Why are they successful? They're very successful because they know exactly what they want to achieve. And they're like a laser on it. And every decision they make influences how they get to this end point. They know it's not going to be linear, but they know exactly what they want to achieve, and then every decision is driven accordingly. That makes it hugely beneficial for us Because when you come to us and ask us for capital, you're already thinking about the things that we're thinking about. And it helps us actually get the capital into your back pockets. And so the unsuccessful ones are the ones that say, please, I need to borrow £1 million. Why do you need to borrow it? Oh, not really sure. Want to grow my business. You've got to be absolutely crystal clear on what that event is and what you want it to look like. And you will find us being, I don't want to say more helpful, but you will find us just being able to deploy capital into your businesses and create more wealth for you a hell of a lot more easily than just saying, I need to borrow £1 million. I hope that helps, James. But I do think spending a lot of time on that is incredibly valuable.
Well, if you was here this morning, we'd done about an hour on that. But you came late, so punctual is...
I work on African time.
Yeah. No, I just want to say a personal thank yous to certainly PQ, who's my main bank manager up here, and has supported me through my career over the last 7-8 years, and Russ and Dave Oram before, Greg, we've just started working together, and Dave just started working together, but certainly PQ, if you can find yourself a good bank manager that you can get a mobile phone number and they will come and see your business, which is, I appreciate, is rarer than ever before. I actually probably say it's easier to borrow £1 million than find someone that really cares about your business. And all of you, you've been monumental in the stuff that we've created, but certainly you, PQ, more than the others, just because you've lent me the most so far.
I'm still charging you for this, so don't count yourself.
So, and I also appreciate, guys, that some of these people are, you're at different levels of your business, and some of these, Investec and Coutts probably, and even the stuff that you do, but Ross, you look after 6 million plus revenue businesses, then 5 million plus revenue businesses. So that's not everyone, but hopefully what we've done today, and there are a lot of you that are qualified for these guys, hopefully we've made you think a little bit different, and certainly got the cogs moving. So can we give them a round of applause? We're doing this next year. Will you come back on our funding panel next year? Thank you very much. There you go. Barclays were the most complicated to get on here. It went through like 17 different levels of internal HR to get them here. So thank you very much. A big round of applause and safe journeys home.